Here to show you the market moves before the market moves you. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Fears of AI disruption ripple through markets, hitting software makers and ad agencies, as well as finance and investment firms.
A divergence in pharma. Eli Lilly sees surging sales. Novo Nordisk forecasts a steep decline.
And from Santander's Webster takeover to NVIDIA's OpenAI investment, Dealmaking is back ahead of the debut of Dani's new show, Bloomberg Deals.
Oh, I didn't know we were going to do that at the top of the show. Thank you,
yes.
Matt. I happen to be looking forward to it, too. One of the things, by the way, we're going to cover on
Wait,
Deals.
don't you just want to tell everyone first?
What, that it?
Kicking off at noon.
Sorry, yes, kicking off.
Every Wednesday. It's an hour-long program starting today.
Thank you, yes. With Matt as our official hype man of Bloomberg Deals, our mascot, if you will. I'm also looking at some of the software stocks. Are these the deals gone bad? They are in pain, or they were in pain yesterday. LegalZoom trade desk got hit really hard. They're down again this morning. Some of the private capital firms also down. It's this fear that they're facing a reckoning that AI tools can automate the businesses. So, yes, Matt, a little bit better, but I mean, wow, yesterday was so tough for all the software and any investing stocks, regardless of how much exposure they have to it.
Yeah, it was rough. We're going to talk to Mark Douglas, the CEO of Mountain, about that this hour, next hour. Eli Lilly gave an upbeat forecast as obesity drug sales remain strong for them. Meanwhile, rival Novo Nordisk says sales could drop as much as 13% this year because of intensifying price competition in the weight loss market. So Lilly shares in the pre-market up 8.5%. Novo down more than 4.5%, Dani.
Another set of earnings we also got this morning. AMD, the sales forecast underwhelmed investors as it struggles to make inroads with AI developments. Let's discuss with Bloomberg Intelligence Global Head of Tech Research, Mandeep Singh. Mandeep, it just feels like another case of where expectations are high. What it was like $9.8 billion is what they forecast, and that beat estimates, but the highest was 10, so we decided it was bad and sent shares down 9%.
And also the guidance that they gave for the March quarter. Anytime, a semiconductor company right now guides to a sequential decline, even though they're being conservative, you will see this kind of stock reaction. And in the case of AMD specifically, we saw how, the storage companies benefited from this build out. The memory companies obviously had a great run. The thinking was the CPU side of AMD would do really well because, you just not only rely on the GPUs, but also the other components within the data center to build this infrastructure. So we didn't see that kind of a bump on the CPU side of AMD as one would have expected. And I think that's where Intel probably has done better on that front.
So that's, though, the hardware side. And on the Odd Lots newsletter, Tracy Alloway put up a striking chart of tech hardware stocks, especially the chip makers, rising, and tech software stocks just plummeting. And of course, yesterday we got, I guess it was just like a press release from Anthropic saying, hey, we can do legal stuff too. But obviously, Joe Weisenthal's been using Claude Code, or whatever it's called, to write his own software. And he's not even like a programming dude, right? So I guess anyone can do it.
Anyone can do it, but look, I think extrapolating that all the existing software companies have no terminal value is probably not the right framework to think about, the level of disruption. And that's where I feel yesterday was one of those days where you could see, everything in the software space was getting hammered. Now, the question that investors have to ask is, what are the type of things that AI or Claude Code could do better in terms of productivity versus just replacing an existing system that's working well? And that's where I don't buy the thesis that, these coding agents would rewrite a lot of the existing software critical systems that are currently being deployed. And I do think there will be that recognition
at some.
Yeah, there will be that recognition because you can't say, oh, everything in software it's like, dead in terms of their growth rates. And ServiceNow, for example, guided to 20% plus growth rate. Now, imagine within the next 3-4 years, they're saying they will double their revenue. And the market is obviously not believing
within
them.
the next 3 or 4 years, they'll probably do like 16 acquisitions, right? You're talking about ServiceNow.
Yeah, but
so I'm sure the revenue will double. Yeah.
I think that's where you have to use that lens. What is the organic growth, to your point? And a lot of these software businesses still are growing organically 10, 12%. There is certainly a headwind to seed growth, and that's the business model change. It has to be more consumption oriented. The gross margins will take a hit. I don't think we have seen that in the numbers yet, but if you are buying AI compute, that's a much higher cost for you than the traditional CPU compute. So your gross margins have to come down. But all these are manageable because they will be offsets in terms of what they could do on the cost side. And that's where we will be in that phase of transition. But I do think a lot of these businesses have very high gross retention. Until the gross retention starts to come down, which is right now 97, 98% for most, system of record companies, I just don't think, you can make that assumption that terminal value is going away.
All right, Mandeep Singh there of Bloomberg Intelligence. He runs our tech coverage for us globally. I'm taking a look at Uber shares. They are higher despite a weak profit outlook as the company invests hundreds of millions of dollars into autonomous tech and plans to launch robo-taxis. Bloomberg Tech's Ed Ludlow joins us now. So, Ed, how big is this push for AVs at Uber, which we normally know as a company that sends us a driver in a car, right?
It's big, and I don't know what you did, but the stock ticked into lower territory after we just came to air. The gyrations of the stock in the pre-market, from a decline of 9% to a gain of 3%, now down 0.6%, basically summarize the anxiety and internal struggle of the market and the company to predict what the world would look like if cars are driven by humans or driven by themselves, robo-taxis, right? The financials, they gave a pretty weak forecast on adjusted EPS, which is a kind of new metric for them separate to their prior EPS guides, and EBITDA was light, but they didn't account for it. No one on the call, thank you, sell side, asked about it either. What they said is, we're launching in more markets around the world for robo-taxi through partners. Capital-light model where they rely on the technology provider. They just do the platform, fleet management and matching with a ride. And they've also promoted somebody from one of the internal finance teams to be CFO, who basically, if you follow this person, Balaji Krishnamurthy on X, is a bit of a robo-taxi evangelist, really believes in Uber's model there. But the market is trying to make sense of well, hold on, your core metrics of human-driven rides were quite strong in the quarter gone. Your outlook's quite light. You don't give us a reason why on the profit side. And longer term, clearly they're committed. I know that doesn't answer your question, but this was a hell of a mixed bag of an earnings print.
Just on that CFO, Ed, if he is someone who's been very bullish on driverless cars, does that change at all the trajectory of Tesla, or not really? It just sort of Uber rather. It just sort of emphasizes where Uber is going anyway.
Uber has had a mixed history of robo-taxis, right? For a period of time, they were working on this themselves, both on the hardware and software side. They shut that program down and transitioned to a strategy of making equity investments in a wide range of different companies, from automakers to the sensor providers to the software stack, and basically saying, we have the Uber app, we are going to partner with these different companies in different jurisdictions, and they will provide the tech. We just hook you up with a rider. And the warning that they're giving right now is that there is not going to be a net zero-sum world where suddenly robo-taxis displace their human-driven business. They don't see, because of regulations, a profitable opportunity there for some time. So they're trying to explain that away for the interim.
Ed, thank you very much for that. That's Bloomberg Tech's Ed Ludlow. Now, elsewhere in earnings, Eli Lilly forecasts an upbeat year for strong sales on demand for its weight loss drug. But its rival, Novo Nordisk, is warning investors could see a steep drop in sales this year.
While we're disappointing the investors today on a short-term price decrease, they will be quite happy to see that we will be able to obtain a lot of gain from the volumes that entails within diabetes and obesity.
We just put the guide out there. We have a very thorough process, and we feel good about the guide that we have in place for 2026. It's still very compelling, by the way, 25%. There is no single pharma company growing at this pace.
Katie Greifeld, co-host of The Close, who did both of those excellent interviews. joins us now. Katie, it just feels like such a change in fortune. It used to be Novo was this giant with obesity medication, and Eli Lilly feels like it's really just come and take over.
Yeah, and these two earnings reports really encapsulate exactly that. I mean, you had Lilly Zepbound take the lead from Novo's Wegovy back in 2025, but think about what we learned just in the past 24 hours. First of all, you had Novo pre-report their earnings. They actually came out with that bad news early. They said that basically sales could drop as much as 13% this year. That was a surprise. That was below even the most bearish analyst forecast. And then you had Eli Lilly this morning, totally different landscape. They basically expect their sales to grow as much as 27% this year. And what's notable is that Novo actually rolled out their obesity pill in the past 4 weeks. Eli Lilly hasn't even gotten there yet. They expect to do that in the second quarter. These numbers, as I understand it, their forecast, and I spoke about this with the CFO, they don't include the obesity pill. So it's going to be interesting, of course, to see that uptake.
I have kind of a contrarian take on the pill. As someone who barely notices the shot that I take every week, why would I want to take a pill every single day? Especially when you have companies like Amgen who say they're going to come out with a shot that lasts for 3 months.
Wait, that's not crazy. People take like vitamins every day. Do you not do stuff like that?
Yeah, but you can't eat or drink within a half hour of when you take the pill. It's like a big deal to remember how to do it, when to do it, what you need to do around it, whereas you could just take a shot that isn't really a shot. I mean, it's not like it hurts, and then not do anything for a week or for 3 months.
Well, Matt, actually, both companies would be really happy to hear you say that, because the hope there is that it's going to expand the market, that they're not going to cannibalize the shots. And again, you had Novo roll out their pill in the last 4 weeks. The CEO told us yesterday that they've seen over 170,000 patients start to take the shot in the past 4 weeks. So again, they're hoping to play up volume here, because we know that pricing is going to be a problem for both of these companies this year. So again, the hope with the shot is that it's going to create more patients, not necessarily have people switching.
All right, I have a lot more to ask Katie, but I'll do it in the commercial break. Because I feel like also there's a story around CVS and where people can get access to these if they want to get the tirzepatide or the semaglutide instead. Katie Greifeld, co-host of The Close, covers the healthcare industry for us, as well as ETFs, every Monday at noon for an hour. Catch her Eli Lilly CFO interview throughout the day. Let's get a look at some of the other movers on our radar. Super Micro Computer Incorporated, SMCI, is among the S&P 500's top movers this morning after reporting strong revenue last quarter.
And some deal news. Texas Instruments on Wednesday is buying chip designer Silicon Labs, a $7.5 billion deal that will help lower manufacturing costs.
Brookfield Asset Management tapped Connor Teskey as its next CEO, succeeding Bruce Flatt's 23-year tenure. Bruce Flatt, a legend in the industry, is going to step down as the CEO. I would like to ask him a load of questions.
Well, funny you should say that, because Bruce Flatt will be joining the premiere of The Deal Show around 12 p.m. noontime. I should point out he is still the CEO of Brookfield, just not of Brookfield Asset Management. So many questions. It's the end of an era. Really excited to have this conversation, Matt.
Yeah, I'm excited to talk to Mike Mayo, because the famed bank analyst from Wells Fargo says there will be more consolidation ahead. He tells us the main suspects that he's watching next. This is Bloomberg Open Interest. Getting out of high interest, look at what's making headlines around the world. President Trump and Chinese President Xi Jinping spoke by phone earlier today, according to a Chinese news agency. The call comes ahead of a proposed meeting in April. No details were released, and it followed Xi's recent call with Russia's President Vladimir Putin as well. Federal Reserve Governor Stephen Miran is stepping down from his role leading the White House Council of Economic Advisors. Miran had been on unpaid leave from the CEA while serving at the Fed, an arrangement that drew criticism from Senate Democrats over Fed independence. In a letter to President Trump, Miran said he was honoring a promise to fully sever White House ties while remaining at the Fed. And Spain's biggest lender, Banco Santander, is buying Webster Financial for $12 billion. That's its biggest push yet into the U.S. The CEO, Ana Botín, spoke with Bloomberg TV about the announcement.
They have 80% commercial business. We have mostly consumer. Together, we're going to take the Santander US, now with the corporate bank, also to 18% return on tangible equity. That is best-in-class profitability by 2028 among the top banks in the United States. Again, US has always been a core market. This is a bolt-on but strategically important acquisition because it drives us to our ultimate goal, which is to be one of the most profitable banks in each geography.
And the deal is expected to close later this year. Dani, we have the perfect guest to talk about this.
Yeah, we do, because Wells Fargo sees a new era of bank consolidation happening. Mike Mayo says that we anticipate more bank deals given pent-up demand, greater need for scale, and a generational change in regulation for faster and more certain merger approvals. Let's get right to the man himself, Wells Fargo head of large cap and mid cap bank research, Mike Mayo. Mike, thank you so much for joining. What an exciting time for the industry and for you. You must be a very busy man. What is the biggest driver? Because that need to consolidate has been around. Is it just that the regulation is letting the banks do this now?
Well, scale has never been more important. And to put things in context, the bank that just sold, it would have taken them a decade and a half of spending to equal what JP Morgan's going to be spending just on technology this year. So it's never been more competitive. But also the regulatory environment, it suppressed the level of bank mergers. I think that was a huge mistake. It was just a gift to Jamie Dimon, like just increased the moats around the business. And then the regulators are approving deals, faster with more certainty, and I think that's a good step. So, look, there's a need for economies of scale. There's an ability with regulations, and then we just had this big merger yesterday. I think this is the start of a new era for bank consolidation. I think the window is literally now.
So the question then is, who's next, Mike? And how far do we go? I mean, there's like 4,000 or 5,000 banks in America, right?
Yeah, 4,600 banks in the U.S., down from 15,000, a few decades ago. And I think that number could be cut in half over the next decade. And to say, who's next, I, resurrected my bank takeover model from the 1990s when we had a lot of consolidation. And we have a new report out today. And what we do is we look at book value and adjust that for hidden book value. Accounting has its shortfalls, so we mark to market the balance sheet. And I found that hidden book value typically equals 50% more than book value. So if you look at stock prices relative to franchise value, several banks trade below their franchise values even before an acquisition. So if there's an acquisition or not, then I think these stocks should go higher, like Bank United or Bank of California or Associated. Those are three banks all trading below their franchise value.
Bank United, Bank of California, and
Associated.
Well, a lot of these deals, the majority that we've seen take place are smaller regionals or super regionals buying another regional bank. Santander was different yesterday, coming in to buy an American bank. Do you think that's a rarity, or could we see more deals that look like that, more cross-border deals, or more bigger banks buying smaller banks?
Well, that was a surprise to many people. Banco Santander, I mean, everyone asked, who's the buyer? Not many people mentioned Banco Santander. So it's a reminder that it's not just U.S. banks that are buyers. There's foreign banks. This is a super attractive economy with great capital markets. The U.S. is still the place to be. And so I think there's pent-up demand. And the sellers, by the way, banks really size 20 through 100, stared into the abyss 3 years ago. Remember with the regional bank failures? So if I were them, I would think very seriously about, given the good economy and interest rates are fine, and especially the political and regulatory environment, this is a moment when they probably should think about selling. And long term, can they compete against the Goliaths of the world? So Goliath is winning is still our theme, but we have a barbell strategy that's consistent with my weightlifting and everything else. But on the one end, we have the Goliath like Citigroup, which is my number one pick. And on the other end, we have kind of this takeover basket with those three names and others.
By the way, I just want to point out that there was a report a few months ago that Chris Waller could lift, and I'm talking about deadlift, right? Or maybe a squat, 300 pounds. It wasn't a bench, I'm sure. But you're up to what, like 450, 457?
Yeah, so Governor Waller has some videos online of deadlifting over 300 pounds, which is amazing. But I'll say I've passed 450 pounds. So if he we're considered for the Fed chair. Maybe I could be considered if I live more. I'm not sure what the criteria are.
I want to just ask about the new Fed chair, because we did find out Kevin Warsh is, if and when he is approved by the Senate, going to come into that position. How will that affect the regulatory outlook for M&A? Do we know what Warsh's take on that is?
Well, Vice Chairman Michelle Bowman has been very clear that regulation has had too much mission creep. So when I worked at the Fed 35 years ago, the rules were simple, but not that effective. Then they became complex and strong, and I think the goal now is to make them simpler and strong. So eliminate the bureaucracy, eliminate the red tape, make the rules for capital clear, and focus on safety and soundness. That's the core mandate. And everything else, let banks be banks again. So it creates the potential that banks can do more lending and also the ability to pursue more deals with more certainty on a shorter time frame.
Is there not this fear, though, that you get change at the midterms, a changing administration, and things go backwards?
I don't think they go backwards, but that's the other reason. The moment is now. If you're looking to do bank deals, do it before the midterms. I think you really have a couple years. And with the change in presidency, change in overseers, the sentiment can change. But the moment's now, the next 6 months. If you're a bank out there, I don't care who you are, you're thinking about either buying or selling, or how do you fit in this consolidation puzzle.
Hey, Mike, this was excellent. We need to figure out how much Warsh can bench. I don't know if we know that. That's next. Mike Mayo, thank you so much for joining us, Wells Fargo head of large and mid-cap bank research. By the way, today at 12 p.m. noon, if you haven't heard, it's the debut of Bloomberg Deals. We'll be tracking all the deals, including regional banks. You're watching Open Interest. A check on futures ahead of the opening bell. S&P going a lot of nowhere. NASDAQ 100 futures weighed down by some poor expectations from AMD shares, down 1/3%. Russell 2000 able to put up some outperformance yet again. It was able to outperform yesterday too. It was up 1/3%. Less than 4 minutes until the opening bell. We're going to talk about the rotation out of big tech and software with Threadneedle and Barry.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Investors will be watching today to see if we bounce back from the almost $300 billion AI spooked sell-off that we had in yesterday's market. Right now, futures are little changed on the S&P. NASDAQ futures are still down. The small caps are up, but everything from standalone software companies to consultancies to financial services companies sold off yesterday on the concern that AI, like Anthropic, will eat their lunch. You can see Citi ringing the opening bell at the New York Stock Exchange, and we have, and Citi's done very well, obviously, among the big money setter banks. And we have VenHub ringing the bell at the NASDAQ. They've just gone public, I think, yesterday or the day before, and they operate like, I mean, in their description is every buzzword you need. AI, robotic, staffless stores.
Is that one of the, like a model store?
Maybe that's a model of their store. It looks like, yeah, in any case, apparently you go in there, you buy something, it restocks, it takes inventory, it does everything without a staff.
That was like, do you remember there was once a VC that had an idea called Bodega? And it was that, and it was like, we're replacing the Bodega, and people revolted. They were so mad. They were like, we love our Bodega, we like our Bodega cat, stop taking jobs of these people. So it's kind of similar.
Yeah, it's interesting.
Yeah, very interesting. Anyway, speaking of interesting, I'm looking at Eli Lilly and Novo Nordisk this morning. Eli Lilly, they gave an upbeat forecast. Obesity drug sales were strong. Meanwhile, Novo Nordisk says that sales could drop as much as 13% this year on intensifying competition in the weight loss market. So a change in fortune between the two of them, Matt.
All right, software stocks and private lenders are steady today after the huge sell-off I was talking about yesterday. This is right now the live trade for LegalZoom, Trade Desk, and KKR. But all of these stocks got hit hard yesterday because traders worry they face a reckoning from AI tools like those offered by Anthropic. Last week, Blackstone's John Gray told us software is among the sectors he is closely watching for disruption.
There's definitely more risk in certain industries. There's no question that you have to think about some of the lower value IT services businesses. And when you think about things like software, for instance, is it a vertical software that is sort of the system of record for a business that is very hard to rip out? or is it some low-level horizontal software where it's easy to change and therefore the AI could lead to a big erosion in your business?
Let's bring in Threadneedle Ventures founder Ann Berry. She's with us here on set. So, Ann, this is something that we've talked about previously. It's not a new idea, obviously, but it's gaining steam in terms of fear in the market. What do you think?
Oh, it's absolutely gaining fear. And I think we're actually seeing companies now willing to make bold moves to deal with it. And I'll give you one example. It's not AI in the purest sense, but it's disruption and a board saying we've got to move. And that's the PayPal exiting of its CEO. For me, that sets a precedent now for what a lot of these software businesses will have to do. Look hard at their management team, see if they're AI savvy, and frankly, make some swift moves if it looks like they're not.
Well, for a lot of these legacy companies, one argument I've heard is that they'll be fine. They have a customer base. Customers are sticky.
Yeah.
So, yeah, maybe there's like something cheaper that comes to market, but people aren't really going to switch and they can adopt and they'll be okay.
Yeah, I don't buy that. And I'll give you a specific example, Adobe. Right, what an absolute disaster that has been in recent years. And, we heard those comments from John Gray just now. That, to me, feels like something that could get ripped out, that does feel a little bit lower level. And it's frustrating because it's had the benefit of time, incumbency, and scale to get ahead of the curve, and it just hasn't done it successfully.
So what do you think is a moat necessary? And I ask you because you interview so many CEOs on your YouTube channel. Who talk about this.
Yeah.
What kind of moat is necessary for a company that offers solutions, right, which every company says they do, that they don't get eaten by AI?
I think it's two things, but they both have to exist. I don't think it's enough anymore to have just one of them. I think it's a huge repository of proprietary data, which an Adobe, for example, ought to have, right? But it's also having the innovation when it comes to the actual tools with which to go and mine and apply that data. And I think both of those need to come together at the same time. So one example that's done this, you and I have talked about Palantir, we talked about the lottery ticket. That is demonstrating if you've got both at the same time, at least from a share price perspective, you can win. If you've got one or the other, I don't think it's looking so optimistic.
Can I ask you about what it looks like from the C-suite, just, going off of, piggyback off what Matt said? Because I was speaking to a very senior deal maker yesterday who basically said one of the reasons deals are happening is because there's a lot of anxiety among CEOs right now, that they want to do big transformations, maybe they're nervous about technology. Are you kind of sensing some of the same feelings out there?
I think what I'm hearing you say, Dani, is that transformational acquisitions can cover sins or can band-aid for growth. And I do think that there is some truth to that for some period of time. But ultimately, the truth does out in the numbers. And when you do these transformational deals, if the synergies aren't realized, if the culture of the company is disrupted, if you lose your best talent, if the growth doesn't materialize, then that ends up backfiring. I do think there's anxiety. I think the most thoughtful CEOs and boards are being very sort of meticulous in their research to figure out how to go after it. I think deals are being driven by a couple of things. People have got big cash balances. They're looking at ways to deploy it. In places like pharmaceuticals, they've got issues with pipeline falling off or not materializing. So I think it's different by sector.
Activists, obviously, are a big push as well. And you have been watching Pepsi very closely. Yesterday, they did kind of a 180 on their strategy, right? They wanted price over volume, and then they were like, actually, no, we're going to cut prices.
No. Yeah, look, I do credit them for at least saying it's not working, so we're going to have to change strategy. It's actually very difficult for public companies to do that versus getting entrenched. But the thing I took away from Pepsi, and you're right, I've been following the money. Elliot's been in there, a very thoughtful strategic plan. There was a lot of chatter in the Pepsi results about performance beverages, the rise of non-alcoholic and emerging markets. I looked at all three of those and said, actually, Monster is the place to go look at. That's actually much better positioned, in my opinion, to win on all of those three fronts.
How much of it is very Pepsi specific versus a consumer problem, that they feel the need to cut prices and Pepsi is responding to that versus just general issues at the company?
Also, maybe consumers aren't eating as much potato chips, or Doritos.
Yeah, but Pepsi has healthier sodas.
There's nothing healthy
kind of
that they
pivot,
offer than water. I mean,
well, the probiotic sodas, right? They've done pretty well. We'll find out. We'll see what they do.
Sure, that's really healthy.
Such a cynic over here. I think it's a consumer issue, Dani. I think we've seen it across the board, and I think Pepsi's been slower to respond to those shifts in consumer preferences than others. I think it's going to figure it out. Again, I think it's got an incumbency benefit. If it can double down and use it, I think it could do well over time. But it's going these things aren't linear. And turnarounds are hard, and I think Pepsi may figure it out. It's just going to take a while.
Lululemon is another company attempting once again a turnaround.
Yes.
Right. The biggest one that I remember was caused by Chip Wilson saying some people on this set saying that some women should not wear his pants.
And
right.
then they do another see-through legging snafu
And
yet
then
again.
they have another problem, and now Chip Wilson is the one doing the critique here.
Yeah, it's lost its cool, right? I think he's been saying from the sidelines. Lululemon to me is sort of the PayPal of the wellness athleisure apparel sector.
What's PayPal, Dani? The Afghanistan payment method?
Yes, because instead of empires, it's been hedge funds that have been in there, yes.
Wow, okay,
Yep.
the metaphors and the analogies get ever more terrifying. Lulu, to me, again, like a PayPal, it was a first mover in tapping into this idea that wellness and apparel was going to be the next frontier, and that athleisure would become something that we'd all wear more of the time than we thought we ever would. It got there, it had in-store experiences, as it was ahead of the curve from that perspective as well, with yoga in store. It did have a cool effect, and it just lost its edge. And I think it got complacent. It didn't have the right leadership in place. I do think there's enough residual goodwill in that brand. It could turn around, but they need to get someone in there pronto.
Like PayPal, and watch their stock drop 20% in a day?
Well, PayPal, look, the question to me that's interesting, that share price reaction, to me, was the market's way of saying the new CEO is not the guy. He's been on the board for, I think, 6 or so years. He's a very impressive executive, but he comes out of a world that isn't consumer-facing payments, that isn't dealing with the likes of the rise of BNPL from fierce competitors. It's a very different product category.
And this was fantastic. Always so nice to have you on.
Thanks for having me, guys.
Threadneedles and Barry. Come back soon, please. Let's get a check on where your equity market stands at the moment, because coming off the back of a very ugly day yesterday where the breadth was good yesterday. You had more movers to the upside than downside, but because you had so many tech-heavy names, that's really what brought us down. You still have good breadth again today. Almost 340 stocks are on the upside. And we're doing okay because the big tech stocks are doing okay. Apple, Microsoft, Alphabet, they're on the top there. Eli Lilly, after very strong earnings, up 8.3%. To the downside, look at how much AMD is getting hammered today. It was their outlook, some disappointment, even though they did say that some sales to China have started to take place, some of their older models. NVIDIA does poorly too. Apparently they're going to spend $20 billion investing in OpenAI. Meta, Boston Scientific also down there in the loser column. Looking at the sectors this morning, Infotech is down because NVIDIA is down. Apple not helping it very much. Energy, that's at the top of the pile as oil continues to gain steam. Materials, consumer staples, industrials, and utilities round out the rest of the top sectors. Matt?
All right, so pretty much everybody gaining today except for IT. Coming up, software struggles. We're going to continue this focus throughout the program as AI disrupts the business model with highly leveraged loans as well. We'll discuss that part of the market next. This is Bloomberg Open Interest.
Let's get you some top calls, the analyst action that we're watching this morning. First up, BTIG upgrading Cloudflare, saying investors are underestimating its growth opportunity. They say that Cloudflare can keep growing at a strong pace as demand rises for protecting and speeding up websites. They also see the recent weakness as a buying opportunity, and buying we are up more than 1% this morning. Next up, Citizens, they cut their view on Booking, saying that growth may slow because new AI tools could make travel websites less essential by letting travelers plan and book trips in one simple conversation. Mizuho, on the other hand, is upgrading, saying AI fears are overblown. Matt, I would totally book something through ChatGPT, wouldn't you?
Yes.
Yeah.
Already do.
Oh, okay. Well, there you go. Maybe the fears are not overblown. Shares are off 4.3% this morning. Finally, Baird, they upgrade Capri Holdings, saying that recent results were better than they looked and the reaction was overdone. The firm points to early signs of improvements at Michael Kors and better profit margins. Those shares only up 0.4%, Matt.
All right, so we're watching those stocks on upgrades and downgrades. Software companies aren't the only ones facing a reckoning from AI disruption. The firms giving loans to those companies are also in the crosshairs. Shares of KKR and Blue Owl were down as much as 10% yesterday over their ties to the software firms that are struggling in the AI era, or those that we maybe speculate are struggling in the AI area. Let's discuss this with Bloomberg Tech's Caroline Hyde and Bloomberg senior private credit reporter Silas Brown. Silas, let me start with you because how exposed are these companies? You know, I hear Dani talking to these private asset, for the most part, guys a lot, and there's always a big share of their money that's lent out to software companies.
Yeah, it was really the darling industry. I mean, it was the industry that could attract the tightest pricing, the loosest lender terms, and the highest valuations on the private equity side. And I think that kind of probable over-exuberance is now being tested as this kind of like great leviathan of AI starts to come into view. And I think one of the defining characteristics of private markets, both on the equity side and the credit side, is that it's pretty hard to get out of the trade once you're in it. And so when the industry has to kind of come to terms with paradigmatic shifts, like what we're seeing now, it can struggle. And I think that's reflected in the share price and in some valuations of the debt too.
So Silas, that's on the private side. Caroline, when it comes to these publicly listed companies, it's a weird one because we knew this threat existed, and it felt like just like the tiniest thing that pushed them over the edge in this Anthropic press release about legal software.
Yeah, a little update. Here we go. Now you can use our generative AI large language model to be able to do contracts, to be able to do an awful lot of the grunt work in law. We knew this was coming. We know that Harvey AI, that other startups in the space had already been deeply selling into the legal sphere, already been trying to disrupt, showing that you didn't need the most junior lawyers anymore. But suddenly Anthropic's prowess, and look, Anthropic has been riding a high, whether you think about what they've been offering in terms of co-work, whether you're thinking about all the vibe coding. Don't get me wrong, OpenAI has exactly the same thing on offer as well with Codex. We are, though, suddenly feeling that the straw is breaking the camel's back, that we've got some post-earnings, ServiceNow didn't live up to expectations enough. None of these companies are quite managing to throw back this instinct from many that they're about to be completely upended in their business models. So no wonder you're seeing $2 trillion evaporate from the market capitalization on Goldman Sachs' basket of software companies, because people just need some tangible evidence that they're not going to be upended in their business model. And thus far, earnings ain't doing it.
You know, Silas, Odd Lots has a great newsletter on the Bloomberg terminal, and they talk about leveraged loans being the canary in the coal mine, or rather they cite someone who made that reference. And I didn't realize there are more leveraged loans now than IG. It's massive, and they've been doing very poorly broadly, you know, even outside of software. Is that part of the problem for companies like KKR, Blue Owl, and other private credit issuers?
Yeah, and actually, I mean, as to what Caroline said, I mean, it has been pretty obvious for quite a long time, and I'm sort of slightly kicking myself that we couldn't get a story about AI and software over the line ahead of time. But it's hard when you can't see kind of tangible evidence of it. And I think the first sign on the credit side has been what's happened with leveraged loans and some of the kind of real, I don't know, sort of star borrowers seeing a kind of hit to their the debt valuation. But yeah, look, I mean, I think all credit markets are coming to terms with it at the same time. The problem with private credit is because of the way that they report and they don't mark to market. We have to wait until the next earnings season, which is approaching us now, to really tell the impact, whether or not they're going to be as kind of instinctive with their marks as the syndicated markets.
Yeah, what Blue Owl, KKR, Ares, all tomorrow will be interesting what they say. We also have Ares CEO Mike Arangetti on the show tomorrow, so we'll definitely ask him about it. But Caroline, if this starts to hit private market players, does that in turn hurt tech? If some of the liquidity spigots potentially get withdrawn, if debt isn't as free-flowing, if private equity isn't willing to come in and do take privates, if there is this concern about the value of these companies?
We wonder how the likes of Meta and Oracle and the others that have been tapping the bond market, syndicated debt, with their investment-grade debt. But also, remember, Blue Owl did this massive deal with Meta at the end of last year. And many were thinking this is the way in which we're going to finance this whole AI hype cycle. The fact infrastructure needs to be built before you really see the productivity evidence that we're starting to glean from an Anthropic or an OpenAI. Well, if Meta isn't going to be able to do so much off-balance sheet, they're going to have to do it all on-balance sheet. What does that mean in terms of driving up the borrowing costs on just the bond market more generally? So that'll be an interesting interesting tell, I think. But we're also just seeing more broadly how much more a CEO is going to be able to articulate that their business isn't getting disrupted. Like we sat on your show last week with the ServiceNow CEO. He's still selling a lot of subscriptions. What more is a guy to do?
Caroline, that was an excellent interview, by the way. Thank you for bringing us that. And thank you for joining us this morning. That's Bloomberg's Caroline Hyde and Silas Brown. And as I mentioned, tomorrow we will be sitting down with the CEO of Ares, Mike Arangetti, to discuss this and a lot more off the back of Ares' earnings report.
Coming up, Eli Lilly gives an upbeat outlook as rival Novo Nordisk sees decline in sales. We'll hear from Lilly's CFO next. This is Bloomberg Open Interest.
Eli Lilly sees sales surging this year in a very sharp contrast to rival Novo Nordisk, which, for its part, sees a steep decline. Bloomberg's Katie Greifeld spoke with Lilly's CFO on what's fueling enthusiasm.
We released our guide for 2026. 25% is the midpoint of the growth that we expect to see in 2026 is industry-leading growth, and that's a continuation of the momentum that we see as well in 2025. By the way, thinking about the Q4 that we also release the revenue that we deliver in the fourth quarter, we deliver 43% growth. So it's a continuation of that strong momentum getting into 2026. What is driving that is the similar drivers, the key growth products that we have. Of course, the incretin is getting all the attention, but we have a breadth of a portfolio across all our therapeutic areas that will continue to drive that growth into 2026. You see that the market in the fourth quarter on the anti-obesity space grew 85%, and we actually outpaced that growth in the fourth quarter. And very strong growth as well in type 2 diabetes, 17%. So we continue to drive that growth into 2026. You mentioned as well the introduction of orforglipron. Very excited. We submitted for regulatory approval in the fourth quarter, and we expect to have regulatory action as early as Q2. So expect to see as well our oral pill coming into the market, a very exciting opportunity to expand the market. In addition to that, we are expanding through access as well with the agreement that we have signed with the administration in Medicare that we expect not later than July will provide access to Medicare patients, more than 40 million patients that could benefit to have access to anti-obesity medications as well.
So you mentioned, of course, the breadth of your portfolio, but investors really, really care about the pill at this moment. So I have to ask a little bit more about that. You mentioned that potential 2Q launch. Is there a possibility that this outlook that you gave this morning gets upgraded as we start to see some of the uptake there?
Yeah, it's early days at this time. We just put the guide out there. We have a very thorough process, and we feel good about the guide that we have in place for 2026.
All right, that was Eli Lilly, CFO, speaking with Bloomberg's Katie Greifeld. Let's take a look at what the market is doing right now. Just about 25 minutes into the session, the S&P 500 is pretty flat right now, 69.24, so still 75, 76 points away from the all-time intraday high. Dani reminded me yesterday it was 7,000, I think 7,002. NASDAQ 100 actually down 0.5% as we continue to see concern around not just software companies, but hardware companies as well in AI. NVIDIA down 1%, AMD down 14% after earnings. Chipotle had earnings and an outlook that's flat, but they're still up today, only 0.33%. Uber earnings, their forecast missed, down 6 2/3%. Novo Nordisk, we know, said sales will fall 13%. Those shares are down 5.5%, but Eli Lilly said sales are going to be great. So with the same product, by the way, so their shares are up almost 8%. Coming up in the next hour, Meredith Whitney joins us right here on set, plus the executive behind a $10 billion loan to create the Project Vault company, and Mark Douglas of Mountain discusses advertising growth and software stocks. This is Bloomberg Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest.
That's Matt Miller. I'm Dani Berger, and it's a market that is resuming its declines. We're down not a lot, about 1/3%, but it comes after an ugly day yesterday, apparently fueled by a press release from Anthropic sending software stocks.
Did you see it, by the way? It was just like, it was less than one page.
Tiny.
It was like two
so
paragraphs.
Small. It's remarkable what it did.
Wiped out $300 billion worth of software-related stocks. All right, we have breaking economic data crossing the Bloomberg terminal. ISM Services coming in with a number of other, services index, employment, prices paid, and new orders. Luckily, Mike McKee is here with us, Bloomberg's international economics and policy correspondent, to break it down. So, Mike, what do we know?
What we know is that we've got a kind of reversal here because the ISM Manufacturing Index was up. The ISM Services Index is down. The number is down from what it was last month, which was revised down to the same number, 53.8. That's the January number. December revised down to 53.8 from 54.4. Employment, 50.3 down from 51.7. Now, this will maybe come into play when we do get the non-farm payrolls numbers coming up. And we saw today very few service jobs created in the ADP numbers as well. Prices paid, another one that everybody cares about, 66.6. That's up from 65.1. So more inflation, less business among service industries. 53.1 is the number for new orders after 56.5 in December. So overall, kind of an odd change in the way things have been going.
I was going to say, because the manufacturing earlier this week came in strong, and historically it has been completely the opposite, right? Services strong, manufacturing weak.
Yeah, that's been the story for the last 18 months or so, and manufacturing actually got into expansion. And now we're seeing, we're still in expansion for the services index, but we're seeing definitely a pullback in how high that is.
Hey, Mike, thank you so much for breaking down the data with us. That is Bloomberg's Michael McKee. Let's turn back to this market and AI and software fears. I spoke with Blackstone's John Gray about the risks of disruption.
Everyone's focused on these bubble risks. I think the biggest risk is actually the disruption risk. What happens when industries change overnight, like what we saw to the yellow pages back in the 90s when the internet came along, or what happened to Uber when Uber and Lyft came to the taxi business 10 years ago.
Joining us now is Meredith Whitney, CEO of Meredith Whitney Advisory Group. Thank you so much for joining us this morning.
With you guys.
We love having you, and what a time to have you on. It does feel like there's just this real reckoning happening. It happened a lot yesterday. There's a flavor of it this morning. But is it as dramatic as John Gray says? Is this a yellow pages moment where we're seriously rethinking the viability of some parts of the software industry?
I think time will tell. It happens slowly and then suddenly, right? So, I think people are scared because valuations have been so high. So much of it, the expectations have, so much has been priced in terms of expectation that there's a very low margin, small margin for error. But you're seeing it across markets. So, my wheelhouse is financial services and the consumer, and financial services, which are usually a completely bland trading group, has had incredible volatility.
Got crushed yesterday because of this, which I thought was so odd. We put up the Anthropic announcement and then showed, like London Stock Exchange and a number of financial services companies.
Thomson Reuters.
Thomson Reuters.
Yeah. So I look at last week into this week, a mortgage servicing company and a mortgage company reported earnings, PFSI, PennyMac, and the stock was down almost 35% and continued its descent yesterday. And I think that the fear is that all the deals that have gone on over the last couple of years at record valuations, were they worth it? So in PFSI case, the idea was that if you had a big servicing portfolio, and sorry to nerd out, but a Bloomberg audience loves this, big servicing portfolio, when customers refinance, they'd be able to recapture all that refinancing. And that didn't turn out to be the case for PFSI. So the stock got walloped.
Look at the full year chart here.
Yeah.
And that's a 12-month picture. Lost everything and then some in basically a couple of trading sessions.
And they didn't take a write down to their MSR asset, which is questionable. And I think everyone's questioning the asset value and the goodwill, the asset values on everyone's balance sheets.
I was going to say, because I had talked, I cover a lot of the private market space, and I had talked to people who said, just wait, there are big write downs coming, specifically in software and software lendings. There are bankruptcies coming, but we don't see it yet, because of the nature of it. And it kind of feeds back into this fear of what's happening in private credit markets right now.
Yep.
Do you think the opacity of this industry does mean that the fears we're seeing in public markets are warranted, and we are about to see a lens, maybe when write-downs finally start to happen, of some real pain out there?
Well, a lot of the private equity funds don't have to take mark to market, so you just don't see it. So it's not like the banks or some of the other lenders that are regulated to such a degree that you're going to see it on a quarterly basis. So you just have to take their word for it. So I look at an Owl Financial that has not been able to recover because investors think that there's a write-down coming, and they say everything to the opposite, but no one believes them. And you think about B-REIT that people still don't trust a B-REIT, and B-REIT's not public, but the associated stock is. And so it's only as good as the market is a faith-based system, and if people lose faith and valuations are high, valuations are going to come crumbling down. Now, there's a good example of creating buying opportunities. So one of the stocks that I'm really bullish on is Champion Home. It's a manufactured housing company, Sky Financial, and that stock got walloped with association from a peer that missed earnings last week, and the stock's up, a ton today because they reported last night. So, if you know the names that you're buying and you look and you put limit orders in, you can do well.
By the way, this all reminds me what you're talking about, Dani, with private credit, of Dan Zwirn's comment yesterday, that the latency has never been so big between something bad happening and the market finding out about it.
Yeah.
And that's pretty shocking to make that kind of statement, right? We lived through the financial crisis.
Yeah.
A lot of bad things happened that people tried to hide, but it just came out more quickly because we didn't have so many opaque assets.
Yeah, well, in that case, going back to the financial crisis, one of the things that took so long was the rating agencies were so behind the eight ball in terms of downgrading securities that got a rating one time in their life, and then they just forgot about them. And so they had to rush and downgrade huge swaths of securities, and that's when the banks had to take write-downs and raise capital. So it's different because the private credit is effectively long-term capital, or perceived as long-term capital, so they don't have the same pressures.
I want to get back. You mentioned Champion Homes, and you've always been so good on housing. Yesterday we got news that President Trump, or that I should say developers, home builders, want to put up 1 million affordable homes, calling them Trump homes. And I was thinking about the fact that everyone says we have a supply problem in this country, right? Not at the top end, but clearly at the affordable end. So is that a good first step?
I don't, it's very unclear. So they float these trial balloons with not a lot of detail, see who bites, and then see how it works.
It's also part of what Ken Griffin was saying yesterday, right? They've got to try and win favor with the president. So they're like, let's say we're going to build 1 million homes.
Right. And then I think the home builders, was it last week or the week before, convened at the Commerce Department with Lutnick. So everybody's trying to find solutions. So the Senate has a proposal, which is road to affordable housing, and the House has a proposal, which is housing for the 21st century. Now, the administration wants to bypass any type of legislation. You need both. You need legislation, and you also need, I think, an executive stick to use versus carrot to use with the governors to force. So 70% of the housing issues are local. So if the governors of states were to sort of force municipalities, because they hold the purse strings,
because there's like a NIMBY thing, or they don't want to spend the money.
It's both. Yeah. So HUD can transfer a lot of money to the states, but the governor's going to disperse that. So I think a lot of things in terms of zoning NIMBY, in terms of transferring commercial properties to residential properties, again, lot size. A lot of this is in. And also both bills talk to manufactured housing as being the solution for affordable housing.
By the way, I have a viewer writing in, Meredith, who says, what about raising that amount that's not taxed once the house is sold from $500,000 to $1 million? Because the previous limit is from the 90s, right? And we've moved on to a much more expensive.
That's an idea that's popular. However, I don't think that's why people aren't selling their homes. That's separate. I think we need a lot of new construction to address the affordable housing. The biggest issue is that 60% of homes are owned by seniors, and they are not moving. And it's more affordable to stay in their homes, and they're accessing things like home equity loans to afford higher prices just cumulative inflation.
Keep paying taxes.
Yeah, and then and rising insurance costs, and so they have more flexibility, so they don't have to sell, and they want to stay in their homes. So that's what is keeping the housing market gummed up. So that is a nice idea, but I don't think that's the big problem with why housing is not affordable for so many. You just need much more production.
I realize housing has always been political to a large degree just because of the large swath of population impacts, but just as you're speaking, it strikes me about how the industries that you focus on feel especially political right now, from housing to financial services with all the credit card stuff that's going on. How are you approaching it, whether it be an announcement of Trump houses, whether it be a Truth Social post from the president? What is sort of the line between this is bad versus this is noise?
Well, and your company's based in Washington, D.C.
That too.
Yeah. So I'm very close with the legislative process. On the administrative process, I think, it's strange to react to a tweet with not a lot of detail. And the muscle memory is it's a trial balloon, and that's it. So remember, the 50-year mortgage was floated. Being able to tap into your 401k to do a down payment. The problem is young people
Portable
don't.
mortgages.
Right, portable mortgages. Young people don't, which is not something that works, right? But young people don't have 401ks. So the bulk of what I call avocado toasters, 24 to 38, they don't. The majority don't own homes, and they don't have big 401ks that they can tap into. So a lot of these are non-starters. I really appreciate the effort, but you've got to have an end policy to address affordable housing.
All right, Meredith, great having you here as always. Hope we can get you back next time you're in New York. Meredith Whitney there of the Meredith Whitney Advisory Group. Coming up, Project Vault. The Trump administration makes a push to secure critical minerals for the safety of the United States and to counter China. The chairman of the Export-Import Bank, which has put its biggest, loan ever into this idea, joins us next. This is Bloomberg. Normally we end on that, but we have a pretty exciting event happening today, a premiere.
We just might, 12 p.m. If you hadn't heard of it, 12 p.m. New York time. It is the debut of Bloomberg Deals, my new show tracking power players' major moves and capital's flowing, shaping global markets. We have so much to talk about, be it government deals, be it the private sector. Stay with us for the rest of this program and then tune back again at noon. You're watching Open Interest.
Sorry.
The defense sector knows that they need to actually choose different sources of supply from China. And actually, it's a tricky thing because it turns out these critical minerals and magnets are embedded within assemblies. So it's a complex process that aerospace and defense suppliers are going through to determine how do we get access to the ex-China supplies.
That was USA Rare Earths CEO Barbara Hampton discussing the U.S.'s heavy reliance on China for critical minerals. This hour, the Trump administration is hosting a summit on critical minerals with officials from around 50 countries. And that summit comes on the heels of the president's critical minerals stockpile initiative that is now known as Project Vault. Joining us is John Jovanovic, president and chairman of the Export-Import Bank, which is funding the $10 billion loan for Project Vault. John, great to have you on the program. Thanks so much for joining us. Talk to us first about what this actually is, because I think a lot of people hear us talking about critical minerals and don't realize this is an ever-growing list of 50, maybe 60, soon to be 70 different kinds of elements that we need to build things in this country.
Yeah, and thank you, Matt. And that's exactly the point. For far too long, we've been talking about doing something about this critical issue. And thanks to President Trump's leadership, we're actually doing something about it in a significant way. And so, the president challenged us to figure out a creative mechanism to create the first ever strategic critical minerals reserve in American history. And at the Export-Import Bank of the United States, we knew we had to think very differently about the problem. We knew what the president expected from us. We had to deliver in a big way, a way that was scalable, a way that helped manufacturers across the country, but also helped mining and refining and processing companies really stabilize. But most importantly, Matt, we had to deliver the solution in a way that didn't require the American taxpayer to subsidize it. And so we scoured the globe, reviewing every single potential model, hoping that we could sort of find an archetype out there. And the reality was that none of them were a good fit. And we knew at XM that we had to come up with a uniquely American solution. And that's what the president announced earlier this week, a public-private partnership where everybody pitches in to fix the problem. And we started with the original equipment manufacturers, right? They were best positioned to benefit from a strategic reserve. And so they are pitching in with long-term financial commitments. At XM, we have a domestic mandate that we're fulfilling, and we're pitching in $10 billion worth of capital. And on top of that, we're crowding in, most importantly, U.S. private equity participation. And so we're coming up with a uniquely American solution.
John, why is this a uniquely American solution? It sounds like a pretty Chinese solution, and I don't mean that in a derogatory way, but you've got central control of these assets. You've got the White House dictating how much and what needs to be bought. How is that uniquely American?
I'm not doing a good job of explaining it because that's absolutely not what this is, right? It's a public-private partnership, first of all, where the private sector is actively participating. Number two, it is decentralized in the sense that we're not telling the market what's most important for us to store and for Project Vault to have on hand. The OEMs are sending us all of those demand signals by way of their subscriptions.
Got it. Yeah.
It's very, very different. It's very unique. And quite frankly, it is the perfect balance of America.
Hey, John, with those conversations of OEMs, if I can just jump in, I'm curious, which are the minerals that came up most? What are the specific minerals that you're going to be prioritizing to fill Project Vault?
It's the approved critical minerals list. At this point, it's 60. I know Matt had referenced that perhaps that list will grow. 17 of those are rare earths, and that's the initial focus.
Beyond that, John, I just wonder, as you're doing this, there is this fear, perhaps, that if you're building this stockpile, you'll have an impact on prices. We see this with the oil strategic reserve and the ability to use that to both drive up and drive down prices. So how, as you're building this reserve, do you make sure that you're not impacting the underlying price of the critical minerals themselves?
Dani, it's a great point. And as we were crafting Project Vault, we were very conscious of the fact that we didn't want to create a solution that invited more problems. And so a really important point here is to say that there will be clear mechanisms by which OEMs can access the critical raw materials and instances where we'll be able to release it. But most importantly is for the OEMs, they are where they are because for far too long, they relied on a just-in-time inventory model. And what they got was balance sheet efficiency, but what it created was operational vulnerability. And so the goal here was also to create an attractive alternative that crowded as many OEMs in, both large and small, across America.
How are you? The private participation is interesting. They're putting in, I think, I read yesterday, $1 2/3 billion to the total of almost 12. What's the incentive for them, other than, to do a favor for the White House? And how do you recoup the $10 billion that you're putting in?
There's no favors here. This is absolutely a viable economic model, which is why, Matt, it'll succeed in the long term. For us at the Export-Import Bank, we have an assurance of repayment. We have a fantastic basket of credit risk to look to, and we have physical inventory upon which we'll earn interest and not just return the taxpayer's investment, but also earn a profit that will go to pay down debt. And for the equity participants, these are long-term investors who are via a non-participating preferred equity structure, receiving a cap return. And for the risk reward involved, given all of the credit counterparties, this is an attractive bet for them.
Who are the private investors? Who in the private sector is putting in this money?
Well, here's where you'll have to stay tuned, because on Monday morning, we had our monumentous board vote where we approved the largest ever loan in XM's history, which was the catalyst to getting us all to the finish line. So you'll stay tuned for all the participants involved.
We're looking forward to hearing who that is, John. I got to ask, because I'm always really curious on these things and kind of asking for a friend as well. How did you come up with the name Project Vault?
I wish I could take credit for it. There is a fantastic team that has worked around the clock. And candidly, Dani, this has been the best kept secret in Washington, which is a town, as you all know, is hard to keep a secret in. And we've been working tirelessly. And I think it's really important to note that today, Secretary Rubio, Vice President Vance this morning addressed it, is convening 55 countries to address this very critical problem of how do we bring supply chain security to critical minerals. And you know when the last time we've convened 55 countries to work on such an important economic problem? I'll spare your team the time. Never. And so this is all about the president's agenda in action, us hearing his call and addressing it with an all-of-government solution.
Did the president come up with the name?
All good ideas are the president's.
All right. Oh. All right, John, we'll leave that mysterious last comment there. Thank you so much for joining us, John Jovanovic of the Export-Import Bank. Still ahead, Mountain CEO Mark Douglas is going to be joining to discuss AI disruption fears that have been rippling throughout markets. Stay with us. This is Bloomberg Open Interest.
Let's get a check at what's going on in the market right now. This is the S&P using the move function on the Bloomberg, and you can see we had a big dip and now looking at a bit of a recovery with really positive breadth. We're looking at 380 stocks gaining 120 to the downside. On the upside, Apple is up 2.33% this morning, and Eli Lilly, after putting out a forecast that people like because of the growth in sales or expected growth in sales of the obesity drugs that they sell. The problem is the other way around for Novo Nordisk. On the downside, NVIDIA, with it down 1.33%, it's hard to put up serious gains. And you have AMD falling 14% after its earnings failed to impress. In terms of the split here on the industry group level, only IT and communication services, the hyperscalers, are down. Everybody else is gaining today. When we come back, we're going to talk about the software scare with Mountain CEO Mark Douglas. Investors awaiting earnings from Google due after the closing bell today. The results coming as fears of AI disruption ripples through markets, hitting software makers, investment firms, and ad agencies alike, including Mountain yesterday, along with others like Trade Desk. It took a big 8% hit. Joining us now is the CEO of Mountain, Mark Douglas, to talk about, well, this and Google both. But Mark, let me first ask about connected TV and the space that you're in. Are you worried about AI as a disruptor, or are you more optimistic about AI as a tool?
Well, I would say the latter, more optimistic. And the reason why is because there's so many areas of what we do where we can apply AI models and make and generative AI, which we're already doing with creative, and just make things better and easier for our customers. For example, AI models applied to targeting who should see the various TV commercials, I think is a boom to the business we're in and to many businesses in the advertising space. So we're really excited, investing heavily.
Do you think that there are areas of advertising specifically, or maybe some of the tools that you use that you think is threatened by AI, especially some of the software services, Mark? Do you think it is a space ripe for disruption?
Well, there's with kind of this big a change, meaning kind of the world, the AI era, I guess we'd call it. I mean, there's always a possibility and some likelihood of disruption. But I also think that investors thinking, because there's AI agents now, Salesforce is going to go out of business. In a lot of these big software programs, ours included, there are just tremendous layers of business rules and knowledge and other things that you don't kind of replace with just like agentic AI. And I think the whole thing harpens back to mobile. Like when mobile first became a thing, everyone was worried, is mobile going to replace desktop? And that didn't change the companies in each industry. It just mobile enabled what they did. And I think you're going to see the same thing here, where a lot of big enterprise software companies in our space are using AI to enable even more growth for their business. So I'm not too in agreement with this market sell-off. I think it's very short-sighted.
But Mark, what do you think are the strongest moats that you have? For example, you have AI tools that make advertisements. I've seen a couple of them, and they're very cool. I can imagine a kid making an advertisement with some other AI tools. But the whole process of buying an ad, getting it on the TV stations I want, pointing it at the customers I need to reach, I can't imagine how I would be able to do that with any kind of Claude bot. Like, it just doesn't make sense from start to finish, the whole solution that you offer.
Exactly. It's a lot of technology. Also, it's extremely high volume. We're taking, the 4 million ad requests per second. So that's 350 billion per day. So there's just layers of high-speed infrastructure to connect into that. There's, like you said, all of the knowledge in terms of what makes the best ad, all in the knowledge and who are the best people to see it, how it's measured. All of that is basically, extremely important. What makes this all work, and then AI, for our business and for many business, is just another tool to enable basically better results and to do those things faster.
Mark, as Matt mentioned to kick us off, we're also going to get Alphabet earnings. And it's been kind of, posed this AI existential threat. Is this battle of, is it ChatGPT? Is it Gemini? What does better? I know you use some of Google's services. If I'm reading correctly, you actually switched from AWS to Google Cloud. I mean, the amount of customers that Google has, the brand recognition, just already this corporate layer it serves for so many people. Does that not put it just far ahead of the race at the moment?
Well, I mean, they're obviously doing really well. And one of the big advantages they have is the data. For example, their creative models, the generative models for video. Google has the world's largest library of video on YouTube, and it's growing every day. It's growing at the fastest rate in the world also. And so they have the ability to train their generative AI models for video on YouTube, and just literally no one else has that. And so, and they have those advantages across many of the things they're doing in AI. And I think it's one of the reasons that people were almost shocked at the quality of what they delivered with the kind of second big release of Gemini and what they've done since then. The other thing they're doing in their cloud business is they've made running and gaining access to their AI models easiest on their cloud business, and they've been very aggressive in terms of pricing. It's a really attractive combination, and I think even like 2 quarters ago I was saying Google Cloud is the real deal. They're going to gain share, and they've done that since, and they're going to continue. That kind of tying the AI models to their cloud is just like an incredibly winning strategy for them.
So Mark, you're a customer for a lot of these services, and your colleagues are the ones that are making the big buys from Google or Amazon Web Services or Azure. Who do you see? Do you see one ahead of the others? Do you see certain products that stand out?
Yeah, well, AWS is the biggest in terms of Google Cloud, but that's kind of my point. Whoever has the best models is likely to start to move ahead in terms of cloud hosting also. And that's what's happened with Google. And you see the opposite happening with Microsoft. Azure, I think people are down on right now. And the reason is well, the AI models aren't there in order to entice me to go there. And so, I mean, and so it's also making it the pricing they can offer even on the AI models very.
But what about the coding tools, Mark? Because you got started in this business and the other businesses that you started. You worked at Oracle for Larry. I mean, what do you think these products are capable of? Have you played around with Claude Code, for example?
Yeah, I don't think they're quite as good as people think they are. We are trying to use kind of AI coding tools, and the quality of the code and the volume of it, which is it produces like a simple program we saw produce 4 million lines of code. You don't have a baseline for what that should be. It should be in the thousands of lines of code. So I think those tools have a lot of promise. They're not quite delivering at the level yet that people think they are. So a lot of people trying to use them. And like Meta announced they weren't going to hire any more engineers. Guess what? They just started hiring more engineers. And that's because AI coding tools have a lot of promise, but they're not truly fully there yet. For commercial grade software that a Meta or a Mountain or any other company would be producing.
God, I can't help but wonder just how many companies we're going to start to hear that from. Like, oops, that announcement we made that we were stopping hiring plans. Yeah, we've changed our mind. Mark, we're going to have to end it there.
I think it's going to be a lot.
It's going to be a lot across industries, I'm guessing, right? Because so many industries.
Across it's kind of the thing being talked about with in engineering right now, like where people are saying, "Oh, I thought." We just produced a new product we haven't announced yet. And we did it very quickly, and we did it fastest by just having like a set of very good engineers on it. Trying to do it with AI tools just wasn't fast enough. It wasn't the quality.
Maybe this is a good message for like everyone in college who's watching this that was thinking of changing their major from like engineering to liberal arts. Maybe you don't need to do that quite yet. Mark, such a pleasure to have you on. Please come join us next time you're in New York City. Mountain CEO Mark Douglas. Coming up, Netflix and Warner Brothers executives defend their merger in the Senate. We're going to discuss what the deal could mean for movie theaters with the CEO of the trade group, Cinema United. This is Bloomberg Open Interest.
The abundance of streaming options has made it more challenging for consumers to find the content they want.
Warner and Netflix together will create value for consumers, more opportunities for the creative community.
This consolidation would increase incentives to divert major releases away from theaters to streaming only on Netflix. That would reduce consumer choice and threaten the viability of movie theaters.
Executives from Netflix and Warner Brothers Discovery defending their merger against lawmakers' concerns that it would hurt streaming competition and movie theaters. Joining us now is Michael Leary, President and CEO of Cinema United, the movie theater trade group, which represents 31,000 movie screens in all 50 U.S. states and Canada. Michael, thank you for joining us. And you've been pretty outspoken on this. This is going to hurt movie theaters. What about this deal will change the industry?
Well, thank you very much for having me. There's no question that the deal as currently constructed would be a loss for movie theaters, for people who enjoy seeing movies in theaters, for communities all over this country and around the world. And I think at the end of the day, it'll end up being bad for the industry. Historically, when you see these types of transactions, the production of movies for theaters goes down, the price for consumers go up, and the access to things like the Warner Brothers library becomes harder and harder. So what you end up with is fewer choices for consumers at a higher cost. And I do think that we're in a situation in the theatrical exhibition industry right now where we're very bullish on the future and we're building towards a positive future. And to have a reduction in production of movies for theaters and have price increases is just not what's needed at this point to keep this industry going the way that it should.
Michael, I sympathize with concerns about theater releases. One battle after another came out, and I went to see it twice at the movie theater, once at an Alamo, once at an AMC. But so many people that I asked about it said, when is it coming to streaming? Like, how much of this is just consumer choice? They're too lazy, too busy, or it's too expensive to go out, and they'd rather just watch it from the comfort of their couches.
Well, first of all, thank you for going to the theater twice. It's an excellent movie. I've seen it as well at my local Alamo. I would say this is a very complicated question. There's no doubt that coming out of the pandemic that some people's habits changed. You see that in terms of people not going out to dinner, or some people not even wanting to go back to the office for work. That is true. But I think there's also other things going on in the marketplace which are pushing people to seeing it on streaming. One of the things that we talk a great deal about is the conflation of windows, which is the time that a movie is in theaters. That has been shrinking over and over, has been shrinking more and more over time. And one of the big fears we have with Netflix is they will completely collapse that window and everybody will be in a position where they just say, let's wait and see it on streaming. One of the things that makes us optimistic about the future is that when you look at the data, young people, Generation Z, are going to movies more than they have any time in the past. It's increased 25% in the last year. People between the ages of 10 and 24 list going to the movies as their #1 activity. So we believe we're building the next generation of moviegoers. What we need is a marketplace which stabilizes, puts movies in theaters for a sufficient amount of time so that they can be seen by the public, can build word of mouth, and that people will go see them in the theaters.
That surprises me.
I don't care how big your basement is
if I can
or
just
how big a
jump
screen
in,
you have.
Because I'm just like thinking of a 10-year-old who, I mean, hopefully most aren't like this, but I feel like I see out in the wild kids who are just like tied to phones, that are looking at iPads constantly and are so used to tiny screens in front of them. What's changing? What's leading that if you're seeing younger generations going to movies?
I'm not giving my 10-year-old a phone.
Well, some people are. I know you wouldn't.
That is a horrible parenting decision.
But you see it all of the time. You honestly do.
Sure. Yeah. I think part of it is there's a growing recognition that young people in particular are spending too much time on their phone and too much time on screens. And when you talk to the people in Generation Z and some of these younger folks, part of the reason they go to the theater is to get away from that, is to have a break from from the constant bombardment of information they're getting on the phones. There was recently an article where a Hollywood actor said that when you're making a movie for Netflix, you have to, throughout the movie, repeat what the plot is, because people are so distracted when they're watching it at home that you have to keep reminding them of the plot lines. When you go to a theater, that is a wholly immersive experience, and you're focused on one thing, and that's enjoying a movie on the big screen.
Michael, that just made me think. So I went to the premiere of this Netflix movie called The Rip, and I was talking to a filmmaker there who said kind of something what you were saying, but saying the beginning of a movie now always has to have explosions. Like within the first couple minutes, there needs to be some crazy kind of action, because the assumption is that people are at home, they're going to be distracted, and they need something to actually keep their butts on the sofa. Not just kind of how
and off the phone.
And off the phone. that again. I mean, has this not just like kind of changed the landscape of what movies actually look like? Is there not just like a permanent shift of not only the form and where we watch it and what screen it's on, but how movies are actually being constructed and filmed?
I don't know that it's a permanent shift. I think we are in a consumer-facing business, right? So we're constantly trying to meet the consumers where they are and what they want to see. There's no doubt that there's a lot of energy around action and suspense films, but there's a lot of other great movies out there where nothing explodes. I'll give you an example. One of my favorite movies this year is Hamnet. There's no explosions in that. And so I think that there's a diverse audience out there that wants to see different things. And what we're trying to make sure is that there's not, in the name of, consolidation, there are more options for people to see different things. So it doesn't just become what that person was telling you, something where everything has to blow up and it has to be, a superhero movie, or it has to be this, it has to be that. We want more choice for consumers, not less.
To be fair, he was making a Ben Affleck, Matt Damon movie for Netflix.
Yeah, right? I know. It's correct, but I mean
it was not exactly highbrow cinema.
Yeah. What do you mean? It was highbrow. It was a beautiful film, I have to say. Hey, Michael, we're going to end it there. That's a Cinema United CEO, Michael O'Leary. And this deal and many others we are going to be discussing at 12 noon New York time. It's the debut of Bloomberg Deals. We're going to have a lively debate about Warner Brothers Discovery. We're going to have a veteran of media banking. We're also going to have one of the top lawyers that is representing Warner Brothers Discovery. That's going to happen around 12:30. So a nice little healthy debate. You
have to kick it off with an explosion, right? The first thing you should do.
Or else people aren't going to stay
on Bloomberg Deals. Exactly.
I'm sure the crew here and our overlords would be happy if I just fire off rockets on our set.
Otherwise, the 10-year-old kids watching your show will be on their phones the whole time.
Yes, our demo.
Coming up, private equity is facing an AI reckoning as the industry's software bets unravel, because a lot of people are writing software themselves, including Joe Weisenthal from Odd Lots, and he's going to come on the program. Also happening right now, Treasury Secretary Scott Bessent is testifying before the House, and Bessent says regulation by reflex fails to avert crises. You can watch his testimony on the terminal at Live Go, or follow our blog on the terminal by typing TLIV. This is Bloomberg.
And that this increases the risk of bank runs and erodes depositor confidence. Can you talk more about a targeted expansion of deposit insurance for non-interest-bearing transaction accounts?
Software companies aren't the only stocks facing a reckoning from AI. The firms with loans to those companies are also in the crosshairs. Shares of KKR and Blue Owl were down as much as 10% yesterday over their ties to software firms that are struggling or perceived to be struggling in the AI era. Let's discuss with Bloomberg Odd Lots co-host Joe Weisenthal. And Joe, I bring up that aspect because in your newsletter, I see I'm subscribed to your newsletters for Odd Lots on the Bloomberg, and you had one dedicated to software. Tracy had a great chart in there, software companies outperforming. But you also had one on leveraged loans, showing that there are a lot more than I knew about out there, and they're doing horribly.
You know what I was thinking about? One of the lessons that we learned from the financial crisis is that a lot of the blowups happen in areas that are perceived to be the most stable, right? So it's like you have this thing that everyone says, this is just predictable month after month after month. Housing prices, et cetera. You had 15 years of software as a service where people are paying subscription fees to these software companies to use it. And it's like, oh, this stuff will never get unplugged. It can't get disrupted, et cetera. And it's not necessarily that like all this software is like blowing up per se, or that it's necessarily the case that AI is going to disrupt it. But you at least have the question now, and you at least have the possibility that here's this thing which you thought was going to be an annuity payment for the next 50 years, maybe it's not going to be, and suddenly it's like a 0 to 1 thing where suddenly you just get this really violent correction. That's what we see. And of course, you pile on leverage because it seems so predictable, and then you get some of the market action like we've seen.
Yeah, the Bloomberg Index of Distressed Trading had $17.7 billion of U.S. tech companies in there. That's now the most since October 2022. So it pushed a lot of companies there, but you obviously are a big user of a lot of these programs. I mean, when you look at
this— A new user, too, right? Because you're not traditionally a coding.
No, I don't know anything about coding, but I've always had, I've had things I've wanted to build. I just didn't know how to do it.
So if kind of the idea behind a lot of this is like all of a sudden all these engineers are going to be out of a job, and that you don't need these professionals, and all these firms that have a bunch of engineers are going to go under because anybody can just write the code for a lot of these programs and software as a service is dead. As someone who's played around with it, what do you think of that narrative?
Well, let's be honest. Nobody who doesn't know how to code is going to be like coding travel software or your healthcare, your healthcare portal anytime soon. And so I think that my guess is that there's probably a lot of overstatement about what you can actually just trivially code up. Whatever. I don't think companies necessarily have a lot of interest in doing a lot of these things in-house. On the other hand, you see something like I think there's a lot of panic. So, for example, yesterday, Claude or Anthropic just announced some minor tool to do like contract scanning for legal work, and a bunch of legal data providers fell. So I think there's just sort of this edginess. But it's also true that creating something that at least resembles functioning is really simple, so that any one of us at our desk, at this desk right now, could put up a website and create something that kind of works. And today is the worst it's ever going to be because the tools are only going to get better. And so here's something that exists, and it's only going to get better.
We've been hearing about this for a long time. Last year, Bruce Richards warned on software companies. And when did you talk to John Gray?
Just last week. Yeah.
Last week, John Gray told Dani, this could be a Yellow Pages moment, And I wonder if you think that we're close to that. I mean, maybe a major corporation won't use AI coders to make its consultancy software, but it will have fewer engineers using AI tools to do that.
And that does seem very plausible. And we already see that, for years, people learn to code, and that's a guaranteed path to a job.
We had a whole Business Week edition dedicated
and it's
to that.
not obvious that that's the case anymore. In fact, I think it's very clearly not the case where, the job market for a little while now has clearly been soft. One of these things are sort of bifurcating where you just see these unbelievable salaries for the computer scientists who can push the frontier of AI research, et cetera. And then you have this sort of hollowed, increasingly stressed out middle, I would say, where the job market is clearly not as tight as it was throughout the 2010s for people with tech skills. And that seems very real to me. Again, where the line is in terms of, how trivial is it to replace some of these more advanced legacy software things? I don't think anyone really knows at this point, and I am skeptical that there's going to be this mass, let's just cancel all our subscriptions to the things that we run our business on. But again, a couple years ago, no one was even having this conversation, and so that's a meaningful change.
Yeah, it's probably a worthwhile conversation having. Joe, thank you so much for joining us for it. Joe Weisenthal, of course, the co-host of Bloomberg Odd Lots, one to listen to on Apple, Spotify, or wherever you get your podcasts. Also, don't miss Bloomberg Deals. Matt, have you heard it premieres?
I'm looking forward to the premiere of your program. I will be sitting right here, stage left, to watch that at 12 noon today. This is Bloomberg.